Today I'm going to talk about the difference in gross margin calculation between AI and SaaS companies. An AI company and a traditional SaaS company both claim 85% gross margins. Let's say that. And investors, they love both the pitches. However, 6 months later, the AI company's real gross margins are revealed to be about 50%. So what happened? They were using SaaS gross margin calculations for an AI business model. I've analyzed gross margin calculations across several SaaS and some AI companies, and today I'm going to share with you why AI and SaaS companies need completely different approaches to calculating this very critical metric. I'm a finance exec and I've completed some valuation studies on SaaS and a couple of AI companies recently. And through detailed financial analysis, I've discovered that gross margin calculations, which is one of the most important metrics for investors, are fundamentally different between these business models. Most AI companies are unknowingly misleading investors, and they're themselves using the SaaS gross margin frameworks. I don't blame them, but that's the reality. This mistake is costing them credibility and valuations. So let's talk about the traditional SaaS gross margin calculation. Let's start with how traditional SaaS companies calculate gross margins and why it's so uniquely and beautifully simple. So if you look at the SaaS COGS, what are the components? You have the hosting and the infrastructure cost, right? You have third-party software licenses directly tied to customer usage. You might even have customer support costs. And then of course you have the payment processing fees. But what is not in SaaS cost? You don't have the development costs, the R&D, it goes into the R&D stuff. You don't have the sales and marketing expenses. You don't have the G&A. Most of the personal costs are also not included in there. So the real SaaS example from my analysis, if the revenue is $10 million annually, the hosting cost could be $300K, the third-party licenses could be $200K, the payment processing could be $150. So the total COGS is $650,000 and your margin is about 93%. This works because once a software is built, serving the additional customer cost, the marginal cost is almost nothing. The marginal cost of adding customer 1000 versus customer 1001 is essentially zero. So the SaaS dream, the near zero marginal cost and gross margins that improve with scale is very key. Now let's talk about AI company. What is the reality of the gross margins? AI companies have a completely different cost structure that breaks the SaaS model. AI company cost of goods sold should include inference computing cost. Every time a customer uses your AI, you pay for computing power. Let me share with you a case study off the top. A computer vision company processing $1 million images monthly, their GPU cost could be $12,000 a month. And if the customer usage doubles, the cost double. This is pure COGS, not infrastructure. Then you have to do all the model training and retraining costs. Unlike SaaS software that is built once, AI models need continuous improvement. A real example from this analysis, a monthly model retraining cost could amount to about $8,000 in compute costs. Then you have training data acquisition. It might be $15,000 a month. You have data labeling and preparation, that's $10,000 a month. So your total might be $33,000 a month in COGS alone. Data processing and storage costs. AI companies process massive amounts of data per customer. An example, a natural language processing company. Ingesting the data alone is 0.05 cents per document processed. A customer processes 100,000 documents a month, so the direct cost is about $5,000 a month per customer. And this scales linearly with usage, depending on the contract. Then there are third-party AI services. Many AI companies, they use external APIs for capabilities they don't build in-house. So some of the example costs I've seen, OpenAI API cost could run anywhere from $3,000 to $15,000 a month, depending on usage. What about Google Cloud Vision API? That could be $2,000 to $8,000 a month. There are external data sources you have to consider, $1,000 to $5,000 a month. So you see, there's a hidden cost problem. Most AI companies that I have analyzed put these costs in the wrong categories. Model training goes into R&D, it should be in COGS. The inference cost and infrastructure should be in COGS as well. The data cost should not be in product development, it should be in COGS. So a corrected AI company example, if you're doing a revenue of $10 million annually, your reported COGS could be $500,000, But your actual COGS after all this reclass could be down to about $4.2 million, 58% gross margin. The difference, $3.7 million in costs were hidden in other expense categories below the line. So let's talk about the scaling differences for a moment. Here's what the fundamental difference becomes critical. In a SaaS scaling pattern, the customer won $100 a month for revenue, 0.50 cents marginal cost. Customer 1,000, $100 a month per revenue, 0.52 marginal cost. Customer 10,000, $100 of revenue, maybe 0.53 marginal cost. You see where I'm going with this? Costs stay flat largely while revenue scales. Whereas in AI, if the customer one is $1,000 a month at $300 marginal cost, customer $1,000 a month, and your marginal cost go up to $285. Customer 10,000, your monthly revenue, you have 10,000 customers, your marginal cost goes significantly higher. The costs are scaling with revenue, just slightly more efficiently. So we get into this efficiency trap, right? AI companies often show improving gross margins over time, but it's not the same as SaaS improvement. SaaS improvement go from 85% to 92 to 95%, whereas AI improvement 45% to 52 to 55, reaching efficiency ceiling. A real case study, I analyzed a company that improved gross margin from 40 to 58% over 18 months, which is impressive, right? But the improvement came from better model efficiency. They reduced the inference costs by about 30%, I think. Economies of scale in data processing, there was some reduction based on contract, 15%. And then there's also the pricing optimization that kicks into gear. So they hit a ceiling close to 60% because their fundamental cost structure still required compute power and data processing for every customer interaction. So what are the investor implications and what are the best practices? These differences between AI and SaaS create major implications for valuation and investor relations. So the valuation multiple impact, SaaS companies with 90% gross margins, they get 15 to 25x revenue multiple, whereas AI companies, they might get 12 to 20x revenue multiples. AI companies with 60 to 70% gross margins will get probably 8 to 10 revenue multiple. Investors apply different multiples because they understand the underlying cost structure sustainability. So what would be the best practice, you think, for AI company CFOs? Transparent cost allocation, create clear COGS categories, have line items in your chart of accounts, direct inference cost, model development and training allocated to current customers, data acquisition and processing, third-party AI service costs, and create this unit economics transparency, track and report the cost per API call of transaction, look at the gross margin per customer segment, look at the marginal cost trends over time, look at the infrastructure efficiency improvements. And then you can do your scenario modeling, show the investors how the gross margin progression moves as you scale, show the cost efficiency roadmap and more of a realistic ceiling on the margins. Do some sensitivity analysis for usage pattern changes. And remember, the trust factor is important. I've seen companies lose credibility with investors by initially reporting SaaS-like gross margins and then having to restate them months later. A better approach? Be transparent from day one about your cost structure and margin limitations. Do some comparative benchmarking. When comparing to other companies, look at, pure SaaS, is 80 to 95% margins. And AI-powered SaaS models, 70 to 85% margins. And pure AI ML, you're looking at about 50 to 70% margins. And if you have AI with very heavy services, well, get it down, 40 to 60% margins. Know where you fit and communicate that very clearly. The bottom line is that AI companies cannot use SaaS gross margin calculations and expect accurate results and gain investor credibility. The cost structures are fundamentally different, and trying to force AI economics into SaaS frameworks, they lead to misleading metrics. Be honest about your cost structure, be transparent about your margin limitations, and be very clear about your efficiency roadmap. Investors will respect the honesty and they will reward accurate financial reporting with better valuations than companies trying to hide their true economics. Remember, it's better to have accurate 65% gross margins than fictional 85% margins that fall apart when you're scrutinized. Thank you.